Good morning, Irish Speech, and welcome to Charge the Markets on IG Live. And it's a slightly muted start to the session, really, after yesterday's rally for US markets. We had a better session in the wake of falling oil prices. Saudi Arabia's decision to cut export prices for February really put a lot of pressure on crude, down almost 5% yesterday for US crude, and Brent crude down over 3%, rebounding a little bit in the session, as we'll see in a short while. We also had reports of a survey from the New York Fed about inflation expectations, which showed that among respondents, inflation expectations have fallen to their lowest level in 2 years. So that really calmed markets, I think, after the mixed start to the year. I mean, it's not been a terrible start to the year. We've just tracked a bit lower for most markets, although maybe small caps have taken a bit more of a hit. But overall, just a bit of a shaving off of the gains we saw at the end of December, finishing off that rally. But nonetheless, it was perhaps notable that we didn't see last week a real continuation of the rally of November and December. But with those signs of falling oil prices and inflation expectations falling, there was hope that maybe actually we would start to see the Fed cut rates in maybe May, after, again, a week of people beginning to rein in expectations about when the Fed would cut rates. All this is a fancy way, I think, of saying that essentially we saw markets looking a bit tired at the beginning of the year without much of a catalyst to drive them higher, and people inevitably resulting in some profit taking. And that has changed a little bit yesterday with strong gains for US markets, followed up to an extent in the Asian session. We did see the Nikkei edging back towards 34,000, although a close above that level continues to elude the index. A little bit of a cautious session so far for European markets, and US futures just not quite continuing Monday's strong run. And of course, it's a fairly quiet day again. Monday was quiet. Tuesday, not much on the calendar either, just the US trade balance this afternoon, but that's never particularly market moving anymore. Of course, we're gearing up for big events later in the week. Everything is shoved back a week with US CPI inflation data on Thursday, and then the start of earnings season once again on the Friday, just to really get everyone keyed up for the weekend, and then it's a stop again. So we get US banks reporting on Friday, and that kicks off certainly the mad first 2 weeks of US earnings season, when all the big names are reporting. The first 2 or 3 weeks, really, when everything, banks, tech, and all that gets thrown into the mix for investors, and then it starts to drop off again. But that's really what we're seeing this morning. Oil prices was down heavily yesterday. Gold prices up touch, certainly overnight, trying to recover, but not showing much further headway in early part of the session this morning. But let's start with indices. Starting with the Dow. Currently trading 37,574, and that's holding on to most of the gains made yesterday, really, and that's seeing it back, clawing its way back from an indecisive session on Friday and a bit of a disappointing session on Thursday. So the market really just, certainly this index, about 200 points or so off recent highs, so just 1% or so for the Dow, really, and consolidating more than anything else. For a number of other indices, as I said, most notably the Russell 2000, small caps, it was a bit more of a correction. But for the Dow, it's essentially moved sideways since before Christmas, really. We first regained 37,000, we indeed hit this new record high, as it has to be noted, because we are still within a whisker of new record highs. But we first hit that back in the middle of December. And while we then continued to track higher into New Year, hitting new record highs to round off the year, it then just fell back a touch, really, and not even that much, really. Enough just to shave a few percent or so off the index. But overall, buyers may well be regaining control. I think what we'd like to see now, buyers would want to see, would be that close above the December highs to clear the way, create the new higher highs, clear the way to 38,000, and indeed fresh record highs, which could be, if you see another sustained rally, could be quite a regular occurrence now, although it's understandable, I think, that perhaps investors are cautious ahead of that CPI reading on Thursday. Will it continue to show a downturn in US price data, or will it maybe tick higher a little bit? And that's certainly an interesting one to watch out for when they're with earnings season as well. So the Dow, little change so far, of course, still one of the most popular indices as ever on the IG platforms. That's why we're covering it first, but not too much movement here. Just certainly the recovery, waiting to see whether that can continue in the quiet session this afternoon and into tomorrow. Going across to Japan, another one of the big winners earlier in 2023, and then, as you see, stalled from the middle of June. We hit 34,000, and then we spent the next 6 months getting back there. So it's another example of an index still very much firmly in an uptrend, but because you've seen these huge gains, nigh on 8,000 points in the middle of March from that banking crisis low, if you can cast your minds back that far, 80,000 points or so, up 34,000. And then after a gain of that magnitude, you really just have to pay, if you like, the price of admission. There's the pullback, grind lower highs, lower lows, but still just testing the 200-day moving average, and then the rally that began, as with everything else, from the end of October. But for the Nikkei, of course, it came at a time when you had a strengthening of the yen against the dollar after months and months and months of the dollar hitting the yen hard. And that meant that the Nikkei was left out of the party from late November. And it's now doing its best to try and get back there. We did just knock on the door of 34,000 yesterday. So Monday's session, which was a bit light to start with because of the Japanese holiday, but Monday session then saw price action take hold, and you had buyers moving back in again to take us back to 34,000. So we are knocking on the door of a new multi-decade high. It's the highest level since 1989, as you probably heard people say ad nauseum at the moment, but that's the highest level since right at the end of the 80s, beginning of the 90s. So while the Dow was at a new record high, the Nikkei at 30-year highs, which still is an impressive achievement in itself. It looks like a bullish view has reassessed itself really since late December. It has clawed its way high. It's been fairly choppy, but it is still moving upwards. So it's important, again, not to sort of not see the wood for the trees, if you like, fail to see the wood for the trees rather, because there's a lot of volatility in this index, quite wide swings, but overall the move high is still there. It pulled back in late November, found support around the 100-day, 50-day moving average, and then rallied. And then a clear sign really was that weakness on last Thursday that was then swiftly reversed, and we saw further gains. So the buyers certainly in charge here. Now we wait to see whether we get that close above 34,000. It's not all things going up this morning though. The Hang Seng, which is the big one of the big losers of the year, really. Chinese markets hit 2023 on a high. Expectations were for the reopening of the Chinese economy. We'd see renewed growth, we'd get stimulus, and it all went downhill from there, quite literally in the case of the Hang Seng. Huge downward trend, almost perfect inversion of things like the Nikkei and the DAX and the Nasdaq. And we find ourselves now, as the new year begins, back at or near the lows of 2023, which was above where we were at the end of 2022, but it certainly doesn't look like there's much of a rebound in play. We had a textbook rebound from early December to the 50-day moving average at about 17,060, hit that level, and lo and behold, reversal comes into play. Price action really reasserting itself. A lower high created here around 17,000, we tick that box. Downturn still firmly in place. Price below the 50-day moving average, which is itself is below the 100, which itself is below the 200. So there, you couldn't really create a more textbook downtrend there. I think it has to be said. Lower lows and lower highs all the way through. You do get rebounds, but they're usually quite short term, and then sharp moves to downside. Whether this one plays out in the same way that we did from the mid-November when we saw it go from 18,300 to 16,000 in the space of about a month remains to be seen. But certainly the next levels to watch are around 16,000 itself, and then again we have to zoom out here, so apologies, but then down to October's lows below 15,000, down towards 14,740. And of course, if we were to go and look at the longer term view again for this one, if you go below October and November 2022's lows, we're back to the great financial crisis, really, levels we've not seen since then. So it's a remarkable continuation really of the downtrend we've seen since the beginning of 2018. China's market rebounded in the course of 2020 with everything else, but then topped out and has been a notable underperformance since then. So it's a really a two-year downtrend still firmly in place, with just that October, November, December, January rebound last year into 2022 and into January, just providing a rebound. But sellers firmly in control on this one. So if you're looking for something that displays all the elements of a downtrend, there it is in the Hang Seng, as the conscious opposite of the Dow, knocking on fresh record highs. Turning to FX markets, we've seen interesting moves in euro sterling over the past month or so, almost completely reversing the gains of December. We saw the euro rally firmly against the pound on expectations that maybe the ECB would have to keep rates high, whereas the BOE would start cutting first, and that's now changed. More poor Eurozone data this morning, German data coming through. Interesting, of course, last week you had inflation data from Germany and the Eurozone itself, which was much stronger, which broke the trend of 6 months of declining prices. And yet the euro has continued to fall against the pound. So there's clear signs that maybe the ECB is, even with inflation as strong as it is, certainly thinking about cutting rates. And there were comments from an ECB member this morning saying we don't need to wait too soon if we wanted to move on policy. So again, that's putting a lot of pressure on the euro. Lower high firmly created at 87 pence for the euro, and now we're seeing whether we get further losses down towards that December low at 85.60. And certainly it looks as if the downtrend's reasserted itself here. A tough one to trade in some ways because it doesn't seem to establish a trend for very long, but certainly at the moment you've got this decent reversal, and for that to change, for a more short-term bullish view to emerge, arguably, if you wanted to say maybe there's trendline support coming into play, it could be a little way away. But if you get a move back above 86.40, maybe we could suggest that this one has stabilized and could be on the way short term. The pound itself, once again, rallying against the dollar, shaking off its early weakness in the beginning of the year, back above 127. The dip buys coming in again over the course of the last 2 weeks or so, really defending the area just above 126. You have got, brace yourselves to the excitement, the golden cross, rising 50-day moving average crossing above the 200-day moving average, which comes a bare 3 months after the death cross, which we had there in mid-October for the 50-day moving below the 200-day. So it's an example of how moving averages are useful, and they can really help you to establish where a trend is and where the direction of the trend is. But you do obviously get the signals, because there'll be plenty of false signals, rather, because there'll be plenty of people who thought, okay, you've got this death cross here for the 50-day crossing below the 200-day in October, better to decline. And now we find ourselves back moving up with a golden cross. So very definition of a whipsaw there, a false signal. Maybe this one turns out the same way, only time will tell, but certainly at the moment the buyers really coming in to defend the pound and get it back towards 128. Close above 128, and then we're really into the kind of territory that we saw in July of last year, in the direction overall of 130 and higher. And then the Aussie dollar, this one's a really interesting one, actually, because you've had this huge rebound. I was looking at this yesterday, and here again, I may have talked about this before, so apologies if it's start to dull, but here's your ongoing downtrend from the beginning of 2021. So as well as the Hang Seng on a 2-year downtrend, you do still have this one, the Australian dollar against the US dollar. Here's, again, a similar, not quite as dramatic rebound that we had from the end of October last year towards the peak in January. But the Aussie dollar is always a good proxy for risk, I find. When things are looking up, people tend to buy the Aussie. And when they're turning down again, you get a move to the downside. But this one still very much in the downtrend since the beginning of 2021. Looks very much like a lower high. It certainly mirrors what we saw in the beginning of 2023. So elegantly, 12 months later, we find ourselves heading lower, perhaps. Also, you've got a failure to hold above, say, 68.30 or so, which is exactly what we saw in June of last year before the latest downward move. So yes, it's been rallying sharply on the daily chart, and again, just sort of flagging for information, it can be easy just to get paralyzed by looking at so many charts and so many different time frames, but it has rallied sharply. But it's notable that even with risk appetite beginning to rebound, we're not seeing that in the Australian dollar. So that might be, I think, a tell that we're seeing maybe the reassertion of this downward trend. Here's that weekly downtrend line coming into play there. Definitely one to watch, I think, and it'll be notable if maybe stock markets and other non-US currencies continue to rally. If the Aussie doesn't, that might be a sign that this downtrend is reasserting itself, and certainly might argue for the next thing to watch is going to be that trendline support, potential trendline support as ever, coming in from the of October, break below 66.20, and then maybe we've got an argument for a reassertion of that, and over the course of time back down towards those October and November lows. And finally, turning to gold, had a bit of a miserable day yesterday. We didn't quite hit the 50-day moving average, but certainly a pullback has continued from the end of last year and the beginning of this year, albeit within the context of a broader rally from, again, the lows of October. You had higher lows in the middle of November and the middle of December, and lo and behold, here we are, getting to almost the middle of January, thankfully, I suppose. Maybe there's signs of a recovery here. Not full recovery. I think maybe a risk of jumping in too early, because certainly after yesterday's losses, it's not surprising to see gold try and recover. but maybe this is one to keep on the radar for potential rebound, see if we get another higher low created. In the short term, if it closes back above maybe 2060, that would arguably bolster the case for a higher low being established. In fact, we rebounded from above the 50-day moving average, will send that view as well. 50-day moving average still above the 200-day, but the 100-day as well, moving above the 200-day now for the first time since the beginning of October. But again, this is showing the impressive recovery in gold and perhaps lays the foundation for further upside in the near term. And then oil prices, the one everyone's really watching at the moment, because it seems like we're back to a phase where the market, particularly the stock market, stands or falls by what oil prices do. Yesterday, you had a huge drop in oil prices, crude down 3-4%, almost 5% in the case of US crude. On those reports, Saudi Arabia had lowered its export prices for oil in February. So it shows perhaps underlying weakness in the oil market. After a big decline yesterday, it's unsurprising to see a rebound. And oil prices rather have been really fighting hard to avoid further declines. It's been a volatile couple of weeks here, but the 76 level so far being defended. What it hasn't been able to do, of course, is hold above the 50-day moving average. And we had a rally towards the end of December that then fizzled out. So for the moment, while it remains below, you might continue to argue for a rollover. Close back below 76 and maybe a daily MACD bearish crossover would reinforce that negativity and perhaps open the way again towards these lows from mid-December around 72.70, or even down to the big 71.80 support zone or so that we saw. It is very much still in lower high territory, of course, so that's still the thing to bear in mind. Yes, it's fighting hard to avoid a decline. You can really see the buyers and sellers battling this one out. But unless it closes back above 79.50, it's really hard to muster that short-term bullish view. If that happens, definitely an interesting one to watch. Close above that, close above the late December highs might send a message that we're seeing a turnaround. And if you look to the weekly, just to jump timeframes again, maybe it's doing a similar thing to what we had in May and June of last year in the summer, where we neared the 200-week moving average in this case, and then it rallied. It's not conclusive. It's easy to say, oh, this is bottoming out, it's now going to move higher. That's kind of what your brain is telling you when you look at this chart. And try and keep that open mind, because if we suddenly get a big move lower the next couple of weeks back below 74.40, that would change the picture considerably. But it's definitely a case that we could think plenty of volatility in oil. So whatever you're doing with it, just remember to keep your stops in place and stick to those risk management rules. So for the rest of the day, of course, it's just the US trade balance at 130, which is never particularly market moving, to be honest. It's always one more for information than anything else. So it's still in wait and see mode for Thursday's inflation and Friday's beginning of earnings season, which means maybe you get a bit more upside in indices, maybe it just continues to see some caution. But certainly expecting the Dow just open a little bit down from yesterday's strong close, down around about 60 points or so from where we were yesterday. So a slightly more muted start to the session for US markets. That's it for me. Thank you for joining us. We will see you again tomorrow at 10:30.